You know what's wild? Most people buy stocks the same way they buy lottery tickets, based on a headline, a hunch, a tweet. Maybe their friend said, "Dude, this one's going to the moon." But what if I told you that the stock price is probably the least important thing to look at? It's like buying a $50,000 car and not even checking if there's an engine under the hood. For a lot of people, that drive ends in a ditch. But for the ones who understand what to look for, the ones with the right toolbox, it can be the start of something life-changing. And that's exactly what you're getting today. Welcome to the Complete Beginner's Guide to Stock Analysis. If you've ever looked at words like PE ratio, debt to equity, or cash flow and thought, "This is all Greek to me," you're not alone, but you're in the right place. By the end of this video, you won't just see a stock price. You'll see the business behind it, the risks, the potential, the whole story. Let's open the toolbox. So first, what is stock analysis? At its core, stock analysis is just decision-making with better data. It's how you figure out whether a company is actually worth investing in, whether it's healthy, whether it has a future. There are two big ways to do that: fundamental analysis, which looks at the actual business, and technical analysis, which looks at how the stock price behaves. Most beginners only learn one. You're learning both. Let's start with fundamental analysis. Now, I know the name sounds intimidating, but it's actually simple. Think of it like shopping at a flea market. The price tag says one thing, but the real value? That's up to you to figure out. Fundamental analysis is how you find that real value. It's about asking, is this a solid, profitable, well-run company that's likely to grow? If yes, great. If not, skip it. And to answer that, we break it down into two categories: quantitative analysis and qualitative analysis. Here's the difference. Quantitative is the stuff you can count: revenue, profit, debt, cash flow, the numbers. Qualitative is everything else: the leadership, the brand, the industry, the stuff you feel. Imagine you're building a house. The blueprint and material list? That's quantitative. But whether the builder knows what they're doing? That's qualitative. You need both. So let's dive into the numbers first. When you look at a company's finances, there are three main documents to check. First, the income statement. This shows how much money they made and spent. Did they make a profit or lose money? Second, the balance sheet. This is a snapshot of what the company owns and what it owes. It shows how stable the company is right now. And third, the cash flow statement. This one shows where the money actually goes. Because profit is one thing, but cash pays the bills. You don't need to memorize all of it. Just focus on a few key metrics. First, the PE ratio, price to earnings. This tells you how expensive the stock is compared to its profits. A PE of 15 means you're paying $15 for every dollar of earnings. Lower is cheaper, but higher could mean the company is growing fast. Next, the debt to equity ratio. This tells you how much of the business is funded by debt versus owned. If it's too high, it's risky, like building a skyscraper on a shaky foundation. And third, free cash flow. This is the money the company has left after paying the bills and investing in itself. It's what fuels growth and dividends. If a company has strong, consistent cash flow, that's a very good sign. Now that we've got the numbers, let's talk about the stuff you can't measure so easily. Qualitative analysis. This is where you think like a business owner. First up, management. Who's running the company? Are they experienced? Do they have a good track record? You want leaders who own a stake in the company, people with skin in the game. Next, the business model. How do they make money? And do they have a competitive advantage? That's what Warren Buffett calls a moat. Think of companies like Coca-Cola or Apple. Their brand alone protects them. Or Amazon, with its massive network and scale. That's a moat, and it helps them stay profitable even when competition heats up. And finally, the industry. Is the company riding a long-term trend like AI, clean energy, or digital payments? Or are they in a declining industry that's shrinking every year? Even a great company can struggle in the wrong market. So that's fundamental analysis, the foundation. But remember, knowing what to buy is only half the game. You also need to know when. And that's where technical analysis comes in. Now, don't worry. You don't need to become a chart wizard. Just learn the basics. Technical analysis looks at the stock's price history to spot trends and timing opportunities. Start with the chart. Most people use candlestick charts. These show where the stock opened, closed, and how much it moved. Then look at support and resistance. Support is a price level where the stock tends to bounce up. Resistance is where it struggles to break through. If a stock breaks past resistance, that can be a bullish sign. Next, indicators. You only need a couple to start. One is the RSI, Relative Strength Index. It shows if a stock is overbought or oversold. Above 70, might be overheated. Below 30, could be undervalued. Another is moving averages, which help smooth out the trend and show the stock's direction over time. The goal isn't to predict the future, it's to spot patterns and stack the odds in your favor. So, now the big question, how do you put it all together? Let's say you find a company with growing revenue, low debt, strong leadership, and a healthy cash flow. The chart shows a strong uptrend, and it's sitting right above a support zone. That's not just a good stock, that's a stock with a case. You've done your research, you've built conviction. You're not just buying a ticker, you're investing in a business you understand. That's the difference between gambling and growing wealth. But wait, before you go make your first pick, let me save you from a few common beginner mistakes. Number 1, chasing hype. Don't buy something just because it's trending. If you don't understand it, skip it. Number 2, overtrading. You don't need to buy every week. Some of the best investors buy just a few times a year. Number 3, no plan. Always know when you'll sell and why. Set your targets. Stick to your rules. Now, here's a bonus tip most beginners completely ignore. Read earnings call transcripts. Every quarter, public companies talk to investors and analysts. They explain what's working, what's not, and what's coming. You'll learn more from one transcript than from 100 YouTube comments. It's like being in the room with the CEO. All right, let's bring it all home. You've learned the basics of fundamental analysis, the numbers and the story behind the business. You've touched on technical analysis, the timing and trends behind the price, and most importantly, you've learned how to think like an investor. This is your foundation. This is your edge. Now go practice it. Look up a company, break it down, build a case, and when the time feels right, take action. If this video helped you out, smash that like button. It helps this get seen by more people who are just like you, curious, ready to learn, and serious about building wealth the smart way. And if you're ready for more, hit that subscribe button and turn on notifications. We've got breakdowns, case studies, and deep dives coming soon, and I want you in the loop. Now I want to hear from you. What's one metric or concept from today that finally clicked? Or what company are you excited to analyze with your new skills? Drop it in the comments. I read everyone. This is Growth Minded. Thanks for watching. Let's keep building together.